Hi, everybody. Welcome to our quarterly edition of Bonding Over Bonds. I'm Ali Krautheim, and today I'm joined by Lauren Spalton. Thanks for being here today, Lauren.
Thanks for having me, Allie.
Today, we're going to be covering the current state of the bond market. We finally made it through the third quarter, and we're going to unpack what happened and some potential takeaways for investors.
Well, to start, returns across fixed income were positive for the third quarter. That was driven largely by a decline in yields. And on that front end of the curve, where we see the most impact from changes in rates, really dropped the most.
Absolutely. We saw that markets priced in some additional rate cuts through the end of the year following September's rate cut, as well as into 2026, given the weaker labor data that we've seen. But it seems like there are also some additional unique circumstances going on in the current environment. Could you dive into that a little bit for our audience?
Absolutely. So the Federal Reserve right now is facing a unique set of challenges. So they're faced with stubborn inflation, a weaker labor market. And then on top of that, there are multiple economic results that are coming in unexpectedly positive. So there's pressure on multiple fronts right now that's really muddying the water in terms of the future of monetary policy.
How would you say you're seeing that reflected in fixed income?
So for fixed income, it's credit spreads, right? So right now, credit spreads, that additional compensation that investors receive for taking on incremental risk, those levels are at historic lows right now, meaning that investors are optimistic about the economy, which is great. But in terms of portfolios, what that means is that we are being compensated less for taking on additional risk. So for us, it still makes sense to take a more defensive position. And so we are looking to invest in those asset classes such as treasuries and agency mortgage backed securities. We still think that fixed income is very attractive at this point, mainly due to compelling real yields, the diversification benefits, and relative value compared to equities.
Thank you, Lauren. That was a great summary of some key points for Q3. We appreciate your time, of course. And thanks to everybody watching for bonding with us over bonds.